Great, Gene. Well, thanks for that awesome introduction and for having me on again. I so enjoy coming to present at Traders Coach events. You guys are great. We've known each other for a long time. You're good friends, and your customers are great. We got a lot of overlap. So this is just good fun, and I love presenting to your audience and to mine. I've invited my customers as well, and I love talking about options. Options are super cool. So thank you, traders, for showing up, and I'm looking forward to this presentation. Please make it interactive. Ask questions as we go. Make comments. I just love to hear what's on your mind and to try and make this as valuable a session for you as possible. I was watching as people were typing in, and I was just seeing if anybody was calling in from the Houston area. And I run a live trading room every morning, and one of the guys in the room was calling in from Houston, and I was like, "Really? That's that's dedication. You don't have something more important to be doing right now." But anyway, thoughts and prayers to the folks in Houston. But again, thanks for being here. I'm Dean Jenkins, founder of FollowMeTrades.com, and tonight I want to talk about options, in particular about option pricing and buying options, and what I call the magic of math. So just a quick disclaimer: whatever I present tonight is going to be for education, information purposes. And I'm going to be looking at some live trades. I'm going to show you a couple of my current favorite trades, and I'll be happy to analyze any stocks that you're interested in and offer an option contract opinion on those as well. But I'm not a financial advisor. I'm a trader, and if you like my advice and you want to act on that, that's your decision, right? Each person, I don't know your situation. Only you know what's appropriate for you. So whether anybody places a trade, make an order, an investment, that's their decision. They assume risk for it. All trading and investing, of course, takes risk, involves risk. So this is for education purposes only. It's not financial advice. So what I'm going to cover tonight, the topic here is really why the majority of option buyers lose money. And maybe you've heard that 80% or 90% of option buyers lose money. I don't know if that statistic's true or not. I think I do believe it. But I think there's some reasons why that happens, right? I'm going to talk about the three components of option pricing. What makes up the price of an option? And this is really cool. We're going to get into the magic of math, some very simple arithmetic that's going to put the odds in your favor, on your side. You get to be the house at this casino, right? And why cheap option contracts can be very expensive, and how to be in that minority of option buyers who win. So the whole genesis for this presentation was, I run a stock and option picking service. I run a live trading room. We trade stocks and options there, and I get asked, a lot of the same questions over and over and over again. And pretty soon, I'm saying to myself, people seem to have these same questions, right? Maybe I'll, put my thoughts and my answers down on paper and do a presentation on it. And that's really what this is about. And really the questions that I'm answering are people go, why do you just buy options? Why don't you do spreads? Why don't you do diagonals and strange winged creatures, iron butterflies and condors and stuff? And I have a reason for that. And that's for me, for directional trading, this is the simplest, lowest risk, highest profit strategy. That's my simple answer. But people also ask questions like, I see you're buying an option contract, right? And you're buying it way out of the money and you're buying it way out in time. There's cheaper contracts available. Why don't you buy the cheap ones? And that takes us to topic number 4 here, right? Why cheap option contracts could sometimes be very expensive. Okay. Peter said, "What about weeklies?" And so that's a good intro, Peter. So there's all kinds of option strategies. Kind of an unlimited number of option strategies, right? And I'm not saying my strategy is the only one. It's just the best. It's the best for what I'm doing, right? And it's for my situation and for the charts I'm looking at. I'm a trend or swing trader. I'm looking at directional trades primarily on daily charts. So if I'm looking at a daily chart, the trade's going to take a handful of weeks to play out. So a weekly option is not appropriate for what I'm doing. And there are areas where spreads and straddles and condors and all this stuff makes sense. So I'm going to talk about one narrow area, which is directional swing or trend trading, right? And why I think buying options is a winning strategy. And again, if 80, 90% of people who buy options lose money, I'm going to examine why that happens and how to be in that 10% who are making it. I'll share a couple of my favorite current option trades, and I'll analyze any charts that you're watching. And if it's a good trade setup or pretty good, I'll propose an option contract for it. Okay. Steve's asking, do I lose leaps for swing trading? It's all about how long I think the trade's going to take. We have a method for figuring that out, for estimating how long we expect to be in the trade. If we expect to be in the trade for months, then a leap could be an appropriate instrument. All right, let's do a real basic review, because I know everybody on the call here, we got a lot of people here. We got a good turnout, Gene. Some people are absolute option experts, and some people are really intrigued by options but may not know too much about them. So let's cover just real quickly some very basic fundamentals about what are options. Okay, option is a contract. Gives the buyer, the person who buys a contract, the holder of the contract, the right, and I put it in bold, not the obligation, to buy or sell the underlying asset, stock, at a specific price on or before a specific date, the expiration date. That's why it's called an option. As a buyer of an option contract, you have the option of exercising the contract. You don't have to if you don't want to. Okay? And if you exercise it, you can then buy or sell, based on the type of contract, the underlying asset, the stock, at a predetermined price on or before the expiration date. Okay? So that's an option contract. It gives you the right to buy or sell stock at a predetermined price at or before a certain date. That's really that. An option is that in its absolute simplest form. Chris says you can't hear me. Everybody else, is the audio okay, or did my everything's, I didn't lose it. Okay, everything's good. If it's good in Madison, Wisconsin for Ron, that it's good around the world as far as I'm concerned. Okay, yeah, everything's good. Okay. All right, so that's an option contract. It's a contract you buy, and you have the right to buy stock at a predetermined price on or before a specified date. Okay. The seller is the person who wrote the contract, right? Somebody wrote it, somebody sold it. They have an obligation. They have an obligation to sell or to buy if the owner who bought it exercises the option, right? There's two types of options, calls and puts, right? When you buy a call option, you have the right to, or not the obligation, you have the right to purchase a stock at the strike price at any time before the thing expires. When you buy a put contract, you have the right, but not the obligation, to sell it at the strike price before the expiration date. Pretty cool stuff. Okay, so that's some basic stuff, right? The seller of an option contract, they receive money, right? They sell something, the buyer gives them the money, and the seller gets to keep that money no matter what, right? But they also have unlimited risk if they do not hold the underlying shares. If they sell what's called a naked contract, if they sell a call or a put, give somebody else the right to buy or sell stock, and they don't have those shares, it's called being naked, and they have unlimited risk. I don't sleep well with unlimited risk. That bothers me, actually. Now, some people sell covered options, or they sell spreads where there's, they buy this and sell that, and they offset each other. I understand that. Okay. But at the end of the day, the seller of an option contract, they get money and they get to keep it no matter what. Now, they may have to deliver shares and sell them to you at a price that's way different than the current market, and they may take a huge hit for that. Okay. The buyer of an option contract pays money. They take no action. If the contract expires worthless, then they lose everything that they paid, 100% of it. But this is really important to me. The buyer's risk is limited to what they spend on the contract. So if you go spend $1,000 on option contracts and you're foolish and you let it expire worthless, you lose $1,000. That is the absolute maximum, undisputable, no debate, maximum amount of risk you have, the money you spent on the premium. Okay, it's kind of like when you buy insurance on a car, right? And if you don't crash your car and you spent $500 for 6 months on your insurance, you don't crash it, well, the $500 is gone, but you had insurance, right? It's the same way. Okay, here's why many option buyers lose money. Again, I keep hearing this, and I tell people, yeah, I buy options. They go, well, don't 80% of option buyers lose money? Maybe. I'm not sure, but maybe, right? Here's why they lose money, though, is an option contract can be, and I underline that and I put that in italics, it can be a depreciating asset. It can be losing value. It does not have to be, right? If it had to be and always was, I wouldn't buy them, right? Done correctly, it can be a dramatically appreciating asset, an asset that is gaining value, okay? And that's what we're looking for. The majority of option buyers lose money because they buy the wrong contract. They don't use strategic risk control. They don't control the amount of how much money it's possible to lose. They don't manage the trade correctly. They let the things expire, worthless. I have no idea why you would do that, right? There's a way to manage an option trade, buying it and managing your position there. None of these things have to happen, right? You buy the right contract, you use risk control, you manage the trade, and you never, ever let it expire worthless. In fact, we never let it get close to expiration, okay? So let's be in the 10% minority who make money buying option contracts, because that is absolutely possible. Absolutely possible. I'm going to show you how, okay? So option contracts have a price. You have to pay for them. And the price of an option contract is called the premium, just like an insurance policy, right? It's a premium. Premium is made up of three components. There's three things that go into making up the price of an option premium. The first is implied volatility. And this is based on, the auction that the market is, right? It's how much market participants are bidding the price up or down based on their expectations of price movement in the underlying shares. Okay? The bigger the price swing and the more it's being bid up or down, the more implied volatility. Different than the actual volatility of the underlying asset. Different than actual. This is implied. Okay. There's time value because there's an expiration date on an option contract. At some point, it will end, and then the buyer has no more rights. Right? It expires. So the farther we are away from the expiration date, the greater the time value. The closer we get to the expiration date, the smaller the time value. We got a chart to show that. Okay, and then there's the strike price versus the underlying price, the degree to which the contract is in or out of the money. This is very important. Okay, so these three components make up the total premium, the price, the value of an option contract. Okay, both time value and implied volatility are what are known as extrinsic values. I got it bolded there. Here's the dictionary definition. It means it's not part of the essential nature of something. It's coming from or operating from the outside. So time value and implied volatility are not a part of the internal or intrinsic value of an option contract. They're external, okay? The strike price versus the underlying price represents what is known as intrinsic value. Intrinsic means it belongs to, it's the essential nature, the constitution of a thing. And here's an example, right? A silver dollar has an intrinsic value of $1. So regardless of its condition, of its rarity, whether it's good, bad, common, whatever, a silver dollar is always worth $1. That is its intrinsic value. Indisputable, can't debate it. You can take it, it's legal tender, and you can get $1 worth of goods or services for it. It may have more value if it's rare or special thing, right? It may have additional extrinsic value to collectors, but that's not part of its intrinsic value, which is $1. Right? My wonderful, loving mother-in-law bought these special gold $1 eagle things for my son 15 years ago. It was going to be this awesome investment. Love her heart, but guess what they're worth? They're worth $1, right? They're worth $1. That's their intrinsic value, and there wasn't anything really that special about them. Okay, so pretty clear here on the difference between intrinsic and extrinsic value. These are important concepts as we talk about buying option contracts or about option study at all. Super important. Okay. A call option, just to put it on a chart here, maybe make it a little more obvious, right? So if you buy an option contract and it's got a strike price of $100, meaning you have the right, the contractual, obligated, paid for by golly right to buy stock at $100, and that stock goes up to $120, well, that's a really good deal. right? Because you get to go buy stock for $100 that is currently trading at $120. It has an intrinsic value, just like a dollar bill has a dollar's worth of value, right? You can't take it away. It's worth $20 at a minimum because I can exercise it. I can exercise it and then go buy the stock at 100 and turn around and sell it for 120, and I made $20 a share. It has an intrinsic value, undisputable, of $20. Okay, that's super cool. And go ahead and chime in with questions, comments as we go. A put option contract has intrinsic value if it's in the money. So if you have a put contract with a strike price of $125, meaning I can sell stock for $125, and it's trading down here at 95, it has an intrinsic value of $35. Okay, indisputable. Let's take a quick look at an option chain. I will bring that up real quick here in TradeStation. These values are posted in option chains. Most legitimate trading platforms or option trading services, you can look this data up and you can see it in a table for the various strike prices and expiration dates. So let me go ahead and bring that up. Here we go. Here's an option chain from TradeStation. Here's Gilead. So we're looking here at the September contracts, and you can see for the calls, right? Here's the strike prices down the middle, 76.5, 77, on down, right? Here's the extrinsic value, right, which is 35 and the 35 cents per contract, and the intrinsic value is $5.38 for this particular strike price, 76.5. Okay, notice that current price, let's pick a round number, right? Let's pick 80. Strike price 80, right? The last closing price on Gilead was 81.88, right? For a strike price of 80, guess what the intrinsic value is? It's 188. It's the difference between the strike price and the current price. Okay. Now it's got extrinsic value, which is based on implied volatility and time, how much time is left on the contract, right? That is external to this value here, which is absolute math, the difference between the strike price and the current price. So that's what it looks like on an option chain. All right. All right. Let's keep going. So those are important values: intrinsic, extrinsic. Okay. Time value, which is part of the extrinsic value of an option contract, it decays over the life of the contract. That is why it can be, doesn't have to be, a depreciating asset. And there's this curve, this accelerating curve, right? I think that's not logarithmic. That's the opposite of that. Whatever. What's the mathematical term for that? Somebody will type it in. Anyway, you can see that this rate of decay accelerates as we get very close to expiration. And it is logarithmic. Exponential is the other way if it flipped up. Yes, it's logarithmic. Thank you, Ron. Okay, so this early in the life of the contract, this is fairly flat. We don't experience too much time decay. That's the slow region. As we approach expiration, and particularly as we get closer to 30 days, and this is for a monthly contract, not weeklies, right? It accelerates very rapidly. Okay, this is a fast time decay zone. Okay, this is a scale of days left till expiration. Okay, so the value of the time value portion of the overall price decays over the life of the contract. So that's important to know, and that's why most people think that you lose money, right? If you buy options, you lose money because the price decays over time. Well, the question is how much of the price is exposed to that. So the total value of an option contract is the sum of both the extrinsic and the intrinsic, right? Total value, got a nice little bracket here. So the total value is the sum of the extrinsic plus the intrinsic value. Pretty simple. If a contract is out of the money, meaning if it's a call option, right? And let's go look back at our option chain here, right? Here's Gilead. Current price is 81.88. So the right to buy Gilead at $82 has an intrinsic value of what? Zero. Has zero intrinsic value because price is currently below $82. That's not that special at this moment in time. Right now, this contract will cost you money because people think Gilead's going to go up, and it will be worth some money later. Right? But today it has zero intrinsic value because you would be paying more than you can go buy the shares on the open market, and that's not too exciting. So an out-of-the-money option contract has zero intrinsic value. Its price is 100% extrinsic, meaning implied volatility in time. So an out-of-the-money contract would be highly exposed to time decay, right? It would have a big impact on the overall price. And if you held an out-of-the-money contract, it would be losing value each day. That's not good. Okay. But time decay and changes in implied volatility only affect the extrinsic value. They do not affect the intrinsic value, right? So I kind of plotted the time decay curve over here next to the extrinsic value portion, right? So it only can affect this blue portion, the extrinsic value portion of a contract. Changes in price affect the intrinsic value, right? If it's a call contract and price goes up, right, the intrinsic value goes up. And if price goes down on a call contract, the price goes down. Now, here's where it gets super interesting, is how much does this change? If this goes up $1 in price, how much does the intrinsic value go up? Well, this is where your big fat Greek helper, I couldn't help keying off of the wedding movie, right? Delta. Delta. So here's the Greek symbol. It's triangle. This is a Greek term. There's lots of Greek terms and options. This one is super important when you're buying option contracts. Delta is the measure of the change in an option premium, its value resulting from the change in the underlying security. Value of delta ranges from 0.10 to 0, negative 0.10 to 0 for puts, and 0 to 0.10 for calls. Okay, and the deeper a contract is in the money, the higher the delta is going to be. Let's look at an example here on an option chain again, right? So here's the column for delta, and you can see as we move up this strike price, these prices are getting lower, right? So an $80 strike price call is $1.94 in the money, and it's got a delta of 0.79. The 79.5 strike has a delta of 0.87, 0.97, 1 to 1. This value, what it means is what we expect for a $1 change in the underlying stock price. If it goes up to 81, we expect the option value, the premium, to go up by 79 cents. That's the correlation, right? If this goes up $1, we expect this one to go up 97 cents. If this one goes up, if the 78.5 goes up $1, if the underlying price goes up $1, we expect the 78.5 to go up $1 as well. At that point, it's a 1-to-1 correlation. Okay, so that's how delta works. Yeah, it's 1.0. I got my decimal point in the wrong place. You are correct, Stan. But you saw it there on the chart, right? Okay, so the deeper a contract is in the money, the higher the delta. So that's an important concept, right? So if intrinsic price is a higher proportion of overall premium, when intrinsic price is a higher proportion of the overall premium, the delta is higher. It has to be, right? When intrinsic price is a higher proportion of overall premium, the delta is higher, and the total value of premium is much more sensitive to changes in the underlying share price and less sensitive to extrinsic values like implied volatility in time. So this, on the right-hand side, where we've got a delta of near zero or zero, the entire price is made up of extrinsic value. It's an out-of-the-money contract, right? It's not very sensitive to changes in the underlying price because it has no extrinsic value or intrinsic value. With a low delta, there's a low impact on price. If we have a high delta, right, then intrinsic value is going to be a much higher proportion of the total value of the contract. And therefore, when the price of the stock moves, the the price of the option is going to move much more dramatically. And right, changes in time and volatility are going to have a much smaller impact on the overall price, particularly if this is rising rapidly and becoming a much higher proportion of total price. The values, the change of values in time and volatility can become negligible or unimportant, non-material. So you guys getting this? Hopefully this is new material I'm presenting for the first time, and I was really having fun putting it together. I hope it's coming across clearly, and I'm making it, super easy. Oh yeah, Carol, this is always recorded, barring any technical problems. So we'll have a recording, and I think Jane's going to put it in the archive. Okay. So this is cool stuff. I think I get excited about it. I'm kind of an option trading geek. Okay, geek. So let's look at a scenario here, right? Let's start with the goal, right? The goal is if we want to buy an option contract, we want the contract to appreciate in value the maximum amount, and then we go sell it. We don't have to hold that thing to expiration. We don't have to exercise it. It's a commodity that can be bought and then sold later in time, right? So we want to go buy a contract, and we want to go sell it later for more money. That's the deal. Okay, hey Chris, you're welcome. Thank you. Okay, so let's say we got this trade here. We think Gilead is going to go to $95, and it's sitting here just under 80, right? I took this screenshot earlier. I was looking at Gilead because this is a trade that we are in, and I can't take my eyes off it. It's like when you go buy a new car or paint your house or something, right? We've been in Gilead since we got in at 67.70, and today it rocketed up 8%. And so we're almost up at the target zone. So that's just a thing of beauty, and I can't take my eyes off it. So anyway, here's Gilead. Say we wanted to get into it right now. A little late, but say we wanted to get into it. We got to have a little example here, right? So it's just under $80. We think, hey, it's going to 95. That's the target. We've got some method of analyzing a chart. I've certainly got a method. Most people here are, either customers or have been to my events before, so I've got a method for analyzing it, or your customers or traders coach, and Bennett for sure has a method, right? And ours have a lot of overlap in how we analyze charts and come up with a price target zone, right? But in order to trade this way, you got to have a method for determining a price target. So here we are with Gilead. We think, hey, it's going to $90, right? High probability move up to $90. Okay. Again, the goal is we want to pick a contract that appreciates in value the maximum amount, and then we sell the thing and make money and grow our account and move on to the next trade, so on and so on. So which of these contracts makes sense, right? One that's got 100% extrinsic value, not sensitive to price movement, with a delta of 0. One that's got a low delta, it moves a little bit, but it's more sensitive to time and volatility? Or do we want one that's got a very high delta and is very sensitive to price movement? Well, it's a pretty obvious deal, right? We want this contract. We want one, if we think that in the near future, right, with high probability that Gilead's going up to $90, I want a contract that is going to increase in value the absolute most. And it would be the one with the high delta, with a high degree of intrinsic value and the smallest intrinsic value. All right. So here's the trade. Let's do some numbers here. I put this together on spreadsheets. We can just walk through this step by step. So here's our chart, right? We got Gilead's down here just under 80 earlier today. It's well over 80 now. Got a price target of 90. So option one is we go buy an in-the-money high delta contract. And by the way, all these contracts we're going to look at are December expiration for example purposes, right? So these expire in December. So what are we, August 30th? So September, October, November, middle of December. We're looking at about, 60, 75 days till expiration, all right? So the high delta in the money contract is a $70 strike price, right? 70 is way down here. So this is up here in the money. So let's use $70 as our high delta. The delta on that is 0.87, right? The highest it can be is 1.0. So that's pretty high delta, 0.87. The value of that at 79.50 when I took this snapshot, with Gilead underlying shares sitting at 79.50, the price, the total premium, intrinsic, extrinsic, is $9.93 per share. What you actually end up paying for those is $993 because each contract is for 100 shares, right? So let's trade the same amount of capital for both these trades, right? So we'll use $2,000, right? Bennett and I both teach 2% risk. So if we got a $100,000 account, we would put $2,000 at risk, 2% of the account. So we're going to buy two contracts. We're going to spend almost $2,000, $1,986. Okay. So here we bought two contracts. They're just about $1,000 a piece. We got a delta of 0.87. And this is the question I get asked all the time. They're like, but Dean, that's $1,000 contract. I look in the option chain and I see $54 contracts. Why would I spend $1,000 when I can get a call option for $54? We're going to answer that question, right? Why cheap contracts can be very expensive. Okay, so this is a $95 strike way up here. It's above our target. It's got a delta of 0.10. Right? Remember, the max is 1.0, so this is a very low delta. Value today at the same underlying share price, $79.50, is $54. You can buy 36 of those. You can buy a mess of those. You can paper your garage with them, right? Same amount of capital tied up, roughly $2,000. Okay, so what happens with these two contracts if Gilead goes up and hits the $90 target? And they're both winners. Both winners. That's great. Your low delta, $95 strike price contract is going to make, right? You're going to sell this thing for $83 a piece times 36. You're going to get proceeds of $29.88. You're going to make $1,044 of profit for 53.7% profit. Well, there's nothing wrong with a 53% profit. I'll take that. What about our high delta, which was, right, has higher intrinsic value, is more responsive to moves in the underlying shares, right? Well, its value went up to 2003. We were able to sell it for $4,000, had a profit of 2020 for 101.7%, double the profit of the low delta contract. Okay. Now, what if we had missed the target? It still went up. Our target was 90, but what if it only went to 85? Now we got a little problem, don't we? So if it only went to 85, only, right? We bought the thing when it was at 75, 79.50. We bought this when the stock was at 79.50. It goes to 85. It's not bad, right? It's a respectable move, nearly 10%. Okay. Well, our proceeds on the high delta contract are going to be $3,000, 1,020 profit, 51.4%. That's a win. And I'll take those. I'll bank those every day. What happened with our low delta contract? Not only did it make less money, right, but because it had no intrinsic value, right, and there was less price movement, impacting the implied volatility portion of price, this thing went down dramatically. It went down to $16 per contract, and your gross proceeds on your $2,000 investment were $576. You lost almost $1,700 or 70% of your money. So we're trading the exact same underlying share, the exact expiration date. The price moved of the underlying shares exactly the same amount, same everything. We just bought the wrong contract, right? And it had a devastating effect, right? We lost 70% of our money where we could have made 50% just by buying a different contract. That seems to me like it's really important. What do you guys think? Yeah, Chris, I like at least 80, right? If the trade has a high probability, I'll creep down into the 70s, but I prefer it to be over 80 for sure. All right. Is this cool? This is what I call the magic of math, right? All you got to understand is really the delta, right? And just understand how the contract responds to changes in the underlying thing. And you go back to the goal, right? What was the goal? The goal was we want the contract to appreciate and then we're going to go sell it. Right? So just by choosing the right contract, right, and paying attention to the delta, how much we're in the money, right? Wouldn't that kind of suck to be right? To be right about the chart and go, yes, I accurately predicted that Gilead would go up to $90. It only went to 85, but that's a pretty good move, right? So I was almost perfectly right. I was in the right direction. I lost money. That would just be bad, right? That would just be bad. So I'm having fun with this material. I hope you're getting something out of it. You're enjoying. I hope you're learning something. Um, yeah, Elizabeth, do I typically buy 80 or above? I get it as high as I can, right? And there's a trade-off between the price you're going to pay in premium and the delta, right? Never below 70, and I try and get it as high as I can. Yeah. All right. Bob says it's all caps. Great. Well, super. Okay. So how do you be in the winning 10%? How do you not be part of the 90 or 80% of the traders buying options to lose money? Well, first thing you got to do is have a high probability directional trade setup, higher down, right? Whatever method you use that is returning, you know, consistent results for you that you trust, right? Bennett's got a clear method. I use very similar method, right? We're using a combination of Elliott Wave and the ART software, and I use some Ichimoku Cloud. So we can predict with, satisfactory probability, right? 70, 80% probability whether a chart's going to go up or down, right? So high probability directional trade. This isn't the options approach if you think the market's going to go sideways or you think there's going to be an explosive move a direction based on news, right? There's collars and straddles and other things to do that. This is a directional trade, up or down, right? So you got to have a high probability directional trade setup. You got to have disciplined risk management. So you got to pick the right trade size. Size matters, right? You got to have a method for doing that, and you got to know how much you're willing to lose, what's a tolerable loss on the trade, and you have to have a predetermined stop price where that level would be hit, and you have to have the discipline to get out if it's hit, and don't kick back and go, well, it'll turn around, right? Particularly with an option, time is your enemy, right? If you start waiting for that to happen and it's going the wrong way, and particularly if it goes out of the money, you're going to get stung. So you need to have the right trade size, and you have to have a predetermined, well thought out stop price. And you have to follow it. Okay, you got to use the magic of math, man. Just put it on your side. Put arithmetic and probability on your side by going deep in the money with a high delta and plenty of time to hit that target. You want to be out of the trade at a minimum 30 days before the expiration, ideally more, right? Out of that zone where time decay starts to have a bigger effect on your profitability. I've heard Bennett say, I've been in a couple hundred of Bennett's webinars. I'm a client and I attend client support webinars I have for years, right? And I hear him say over and over, he'll look at a chart and go, oh, this is a great setup, right? You might want to consider an option contract. Be sure you get one deep in the money with a high delta. And he's absolutely right. Right? Yeah, Michael, it's recorded. I think the audio is good for everybody else, and Don, it's being recorded. Yeah. So this is the magic of math, right? These are the keys. So for directional trading, I think. What about for weekly option? I would only trade, weekly options on much shorter time frames. So my approach is primarily on daily charts or 60-minute charts. You could use weekly options if you're trading smaller time frames. Right? You just kind of shrink all this down proportionately, Kai. Okay, so that's 3 simple rules here, right? Be in the winning 10%, people buying options. If you're trading directionally, you got a high probability setup, you have disciplined risk management, you use the magic of math, go deep in the money with a high delta, and have plenty of time to get out before expiration. Okay, so I do have an options course to learn more. I teach my entire options trading strategy. There's all kinds of option types and, a lot of stuff. So I cover 6 modules. I go through option basics, the risks, more deeper into the money, out of the money, covered option naked, more detail into intrinsic, extrinsic, about option pricing, how to interpret chains, the Greek values, contract selection, how prices derive with the Black-Scholes model, how to project profit, how to interpret opt-in symbols, how to manage orders, right? How to place orders, how to manage them, how to manage risk in a simple way and an advanced way, how to analyze the underlying assets, and to have an overall option trading plan. So I teach that, offering a 25% discount. And so for Normal list price is $4.97, and you can get it tonight. In fact, you can get it by Friday midnight for $3.79, 25% discount. Let me pop a link over into the chat area, and that is dropping right now. So Gene had you locate that chat area, so I hope you can see that. Okay, and as a special bonus, we got a little time, so I'm going to hang here and answer questions. I'm going to look at I'm going to show you one of my favorite trades right now, and I'll look at any trade ideas that you might have. But if you sign up tonight during this session, so if you sign up for the class before we hang up, you would get a bonus of 30 days in my live trading room or 30 days of my stock and option picks, whichever one you want. If you sign up, I'll just manually set that up. I'll send you an email. Hey, which one do you want? That's for new customers only, right? If you're an existing in the trading room or the picks, right? This is for new folks. Although if you only got one and you want the other and you sign up, I'll give you that, right? Okay. So it's if you want to learn more, right? 6 modules. They include written PDF, study guide for each module, and recorded videos. So about an hour of teaching on each one, and you have access to me. If you have questions through the course, you can email me. If you really want to talk, we'll get on the phone. We'll book a session. We'll spend a little time. I'll do whatever it takes to help you be successful. Got great feedback from students who have taken this course. I wanted to offer that to you. So that link's there. If you want to go check it out, it goes to a landing page where if you want to learn more and check it out. And Sarah is saying, hey, what do you mean by DeFi money? Go over that again. Let me get this chart. So here, say that, let's use a call. Most people can get their heads around call options a little quicker. So this call option contract has a strike price of $100. That means you get to buy the stock at $100, and it's currently sitting here at $120. That's pretty deep in the money, right? The contract is in the money, meaning if you were to buy that contract and exercise it today, you could buy shares for $100 and go sell them for $120 that day. That means you're in the money. Out of the money means strike price of 100 and it's sitting down here at 90, meaning you couldn't exercise it. Why would you want to buy for 100 when they're trading on the open market for 90? Okay, that's out of the money. So that's what we mean by that. All right. So 25% discount. That's good until Friday midnight, right? There's a countdown on the page. But if you do it, the bonus of 30 days in the trading room or the stock and option picks, right? That's only good while we're online. Once Gene hits the button to stop the webinar and hangs up, that one's off the table. You can still get the $379. You just can't get the bonus of the 30 days of the trading room or the stock and option picks. Okay. Hey, let me show you my favorite trade right now. And then I'll look at some of yours if you're interested. So Gilead's my favorite trade, but it's too late to get into that one. I'm pretty fond of Calumet as well. That one popped today too. We've been in this one for a few weeks, so we got into Calumet at $5. It's a smaller cap oil services company. Thing hit $8 today, just about, and it closed at $7.35. We're in just a stunning amount of profit. And you can see, I was talking about on my example on my spreadsheets on my slides there about 100% profit. Well, that's possible. We're sitting here at 100%, 111% profit on Gilead, 109% profit on Calumet, 52% profit on Vail. These are real trades. These are in my live account. These are ones I publish to the subscribers. So that's absolutely possible. Not every trade wins, some lose, but boy, I'm very fond of those. But you're more interested probably in a trade that still has a good entry, huh? So here's one I like. This is Acacia Communications. This is a long trade. And if you're, most of you are familiar with the ART system and with what Bennett teaches, what I teach. So this is a big wave 3 down. This is a big impulsive move down. And what we've got is really nice sign of a corrective move, a wave 4 beginning here. We took an entry on this in the trading room earlier this week here at 48.18. It's bobbling around here. It's waiting to take off. It'll do it, right? Gilead didn't take off right away, but now look at it. So we got an entry at 48.18. And it's good for a day or two. So you can still get into Acacia, and it's got a stop. Current stop is at 38.49, and it's got a price target, this green line, really nice, up here at 70.64. And you go, well, you're crazy. Is it really going to get up there? Well, I don't know. Calumet did that, right? Absolutely possible. So the option contract I like for that one on Acacia is right here. I like the January 18 $40 call contract. So it expires in January of next year, 2018, $40 strike price call. That's the contract I like for Acacia right now. So there's an awesome trade for you if you're looking for a trade idea. So what do you like? Kai wants to look at Celgene. Okay, CELG. Let's do it. Yeah, Steve says ask how long how do I know how long to hold? Well, I have a trade management plan, right? Not only do I know which contract to buy, but I've got an overall trade management plan that tells me how to manage my stops, manage the trades, and how to get out of it. It's a little beyond the scope, right, of this presentation, but hey, you got to have a trade management plan. Don't go into a trade unless you know how you're getting out. Okay. Oh, great question, Luke. Is the stop based on the underlying chart or the percent loss on the option? It is based on the underlying chart. Everything's based on the underlying chart, right? The option contract is a derivative product, right? Everything that matters really is taking place here on the chart. So I set my stops at key support and resistance levels. I determine my position size based on the entry price and the stop price. But if it hits stop, I'm getting out on the underlying shares, right? So good question, Luke. Thanks. Yeah. So Celgene, pretty sloppy chart. It's in an uptrend, but it's pretty volatile. So I wouldn't be taking a trade. We've had a pretty long uptrend, right? It's been going on since last July or about a year into this trend. So it's gone up, and it looks like it's still going up, but it doesn't really meet my parameters in terms of being able to look for a nice impulsive move and a correction and stuff. So yeah, not for me, Kai. SRPT for Stan. Yeah, Chris has been through my training, and he said a little more bluntly, he goes, "Hey, that's a mess. It is a bit of a mess. Nothing against you, Kai. It's just that chart." Uh, yeah, this one, it had a huge impulsive move. The correction was way too deep. So it's not really sure what's going on here. And here's the deal with what both Bennett and I do with, Elliott Wave being kind of the core of our analysis is you may look at 10 or 15 charts and not see a good setup, right? That's okay. You can't force the patterns onto a chart. They're either there or not. But within a few seconds, we can look at it and go, that's got possibility, and spend some time. But if not, we just move on. Win. So win is it's a pretty orderly market. That's a pretty nice move up. We might see something different here on a weekly chart. Let me look at this. Actually, on the weekly chart, we got an impulsive move down. We're in a correction. Next move is probably down, but it really hasn't started yet. So I would not be going long on win. It may not have much left, is what that looks like on a bigger time frame. UNH. Well, what a beautiful trend, right? United Health. Trend started right back about here. If you factor out that one wick there. So about the beginning of 2016. So here we are a year and 8 months into this trend, and we can see this momentum coming out of it down here. They're a little long in the tooth, a little late for me to be getting long on this. When this begins to correct, it might be a good trade because it's gone up a long way, but too late to go long, too early to go short. I'm just too hard to please, right? I haven't seen a chart yet other than the ones I showed that I like. But I said you can look at 10 or 15 charts. Okay. Facebook may be getting ready to correct. So we've had a nice long move up. Look how it's flattening out. Look how it's consolidating up here. If it starts putting in, and by the way, we've got a couple MP period bearish pyramids. If we start putting in some serious lows, break down through the Ichimoku cloud, the owl is about to go negative. There may be a correction coming soon on Facebook, so that's worth watching. That's probably the best one we've seen so far. BAC. Boy, the symbols are coming. I don't know if I'm going to get to them all. Bank of America. So big bullish move up. It is consolidating seriously. It is starting to break down through the cloud. We're starting to see negative movement in the owl and growing negative movement. So we may be ready for a short. We got a previous low over here. But look at this bearish pyramid. You could take a risk and go short now, or you could let it maybe get another pyramid before. And the target zone is down here. This is the retracement zone. So BAC might be short. Might be looking short. In fact, let's go ahead and look. What option, if I were to get a short on BAC right now, what contract would I use? I'm glad you asked. Okay. I would be out. Let's see what cycle they're on. September, November. That's 106 days out to December. I would be in the January contract. It's a put, right? And so, boy, look at the open interest on the $27, 59,000 put contract, open interest on the $27 strike. You think some people are betting on this going down? I like the 28 or 29. Look at the delta, 84, 89. Those are nice. Well, how are we doing on time? We're okay for a minute. OPK for Ellie. Well, big move down, eh? Came down from 1921. Looks like it might be starting to consolidate and get ready to move up. So it's not ready yet, but you could watch this one real close. And it could shoot up and be a nice correction up, very similar to CLMT that I showed you earlier. So that's one to watch. BDX for Emmanuel. That looks a lot like Facebook, doesn't it? Big impulsive move up, starting to consolidate. Look at the growing momentum down here in the owl. The PTF still green, but it may go red pretty soon. I would look for this big pyramid to get confirmed, and that might be a great sign. That will be a major pyramid, and about that time it'll be breaking down through the cloud. There might be a nice short coming on BDX. Becton Dickinson, I don't know what that is. That's a pretty nice one to watch real close. Nice one, Emmanuel. Stan, how do I handle options with large bid-ask spreads? What's your threshold for skipping? You typically see large bid-ask spreads at very low volume. So I make sure that there's sufficient volume, a sufficient market, an option market for a stock. Typically, the higher the volume you get, typically the tighter the bid, the ask, right? I never place market orders. That's nuts to place market orders for option contracts. You want to use a limit. And if you do have one that everything looks good, but you got a really big bid-ask spread, run an option calculator, right? There's free ones available, like the CBOE has a free option calculator. It preloads all the parameters to run the Black-Scholes model, and it'll tell you what it should be trading at. And you can put a limit order in and try and get it there. But if it's got a high bid-ask spread now, it might have it later. It might be hard to get out of at a good price. So that might scare you off just a little bit. So that's just some thoughts. Okay. You're welcome. Absolutely. Keeping an eye on the clock here. I don't want to run over. I know we scheduled this for an hour, and I want to honor Gene's time and your time and bring it in on time. Okay, so just one more quick look here. I'm sorry I can't get to every symbol. I wish I could because it's good fun. So again, just to rehash, the stock option basics course, you can get it 25% discount until Friday night. And if you sign up during this session before we hang up, You get a bonus of 30 days in my trading room where we're going over picks like this, finding great trades, or my stock and option pick service where you don't have to, log into the room. I just send you the picks every week with updates. So your choice, dealer's choice, right? So any final questions before we go ahead and wrap this up? You're welcome, Dami. I hope I say your name right. You're absolutely welcome. Glad you showed up. Thanks to all the participants. This was a lot of fun. I sure enjoyed it. I loved the topics, and thank you. And I think, Gene, I'll go ahead and turn it back over to you. And thanks again for inviting me to come. I had a great time.
Well, Dean, we always love having you on Wednesday Night Live.